Well, good morning. In previous video we discussed about the swap ratio and solved the one problem under the earning per share method. Okay, in this video we are going to discuss all the three methods of the swap ratio and we are going to solve the problems also. So now just recall what's the meaning of the swap ratio. Okay, swap ratio is nothing but how much of that one acquiring company is going to offer a shares for another acquired company. That means here is the Madhu company is acquiring company. That means Madhu company going to acquire the Sudha company. While acquiring this Sudha company, how much of shares this Madhu company offering to these shareholders of the Sudha company. So that calculation is called as an basically swap ratio. We will calculate that swap ratio with the help of these three methods, net assets method. So that will indicate what are the amount that company have. So while deducting all the assets from the liabilities, that is a net asset value, and the second one is earning per share. Earning per share is nothing but how much of one individual share is earning. So that will calculated earning available to equity shareholders divided by number of equity shares. And the last one is market value. It will shows or it will calculate it with the help of the market price of the one individual share. So that means one individual share ಗೆ market ಅಲ್ಲಿ ಎಷ್ಟು ಪ್ರೈಸ್ ಇದೆ ಅನ್ನೋ ಬೇಸಿಸ್ ಮೇಲೆ we are going to solve the problems or we are going to ascertain the swap ratio, that is a market value method. So now let's start with the net assets value. As I told, so net asset value is equal to so is calculated with the help of assets minus liabilities. We will getting a net assets value. Okay, take a look into this picture. So net assets value is equal to an assets minus liabilities. So how can we say that? So take a look into this balance sheet formula. So assets is equal to liabilities plus shareholders fund. One side there will be an assets, another side will be an liabilities. So in that liabilities, that company will include all the shareholders fund also. So example, in this problem, so okay, in this problem, here is the assets and here is the liabilities. In these liabilities, there will be a shareholders fund also. But we need to segregate the liabilities and deduct all the liabilities from the assets. We will getting a net assets value. Clear? I hope it's clear. So that shareholders fund, that will include all the items of equity, retained earnings, profit and loss, and then share premium and so on. So we need to segregate all the items in order to calculate the net assets value. Clear? So okay, overall that net asset value is nothing but deducting the assets from the liabilities. So that's it. Okay. Okay, first problem. So in order to calculate the net assets value under the swap ratio or share exchange ratio, there will be a formula. Okay, wait. So that is book value per share of acquired company divided by book value per share of acquiring company. What is the meaning of the book value? Book value is nothing but how much of company's value according to their books. Books is nothing but a balance sheet, a profit and loss account, or cash flows, fund flow. According to that books, how much of company's valuing, that will indicate that book value. So in order to calculate the book value of the individual share or individual company, so we have the formula, that is a net assets value divided by number of equity shares. Okay, now we need to calculate first net assets value. As I told, net assets value will calculate it deducting all the assets from the liabilities. We will getting a net assets value. Okay, now take a look into this problem. So now we know that assets are fixed assets and then current assets. We got the assets. So next we need to know the liabilities. So in this liability side, that will include the shareholders fund also. So but we need to take liabilities only. Okay, first one is in 10% debentures. It's an liability. I will tell why. Profit and loss account, it's an equity shareholders fund or shareholders fund. Share premium, it's a shareholders fund. Equity share, it's a shareholders fund. And then the preference share is a liability. Okay, so 10% debentures, it's a liability because of there will be an obligation. Liability meaning is obligation, or we need to owe for other. So 10% debentures after completion of the 1 year or at the end of the financial year, so we need to pay 10% of interest for our lender. Whatever may happen in business, whether it's in profit, whether it's in loss, we need to pay the interest. That's why it's an obligation. Profit and loss account, next profit and loss account, it's an earning available for the equity shareholders, or it may be in profit or loss, it will up to an shareholders. And the third one, it's a share premium. It's nothing but the nominal value, the difference between the nominal value of the individual share with the market value. And the third one is the shareholders fund or share equity shares. That means how much of money that equity shareholders invested in business. And the last one is preference shares will consider as a liability, not a shareholders fund, because of preference share, that word itself is telling the preference, they are going to give in much preference or first preference for the shareholders, so they will pay the fixed dividend that will have the feature of the debentures. So whatever may happen in business, they have to pay the fixed dividend, but in the equity, so the dividend will fluctuate. So if they are getting the good number of profits, or they are getting the losses, that will up to an equity shareholders. They are getting the good profit means they will pay more. So if they are facing the losses means the equity shareholders going to settle their losses. Okay, that's why the preference share is an liability, and then 10% debentures is liability, and the profit and loss is an equity shareholders fund, and the share premium is equity shareholders fund, and then equity share is also an shareholders fund. So now we got an assets, in other sides there will be a liability. We got the liability, that is in 10% debentures, and then preference share. Okay, so in order to calculate the net assets value, we need to deduct the assets with the liabilities. So we got, as I told, we got two items of the assets, and then liabilities, we got two times of the liabilities. Well, the deducting of all the assets with the liabilities, we are getting an net assets value. Okay, next, so with the help of this net assets value, we are going to solve the book value of share. So book value of share is equal to net assets value divided by number of equity shares. We got net assets value. So next, number of equity shares. So that now number of equity shares is, so the Madhu company holding the 5 lakh rupees worth equity shares, and then one individual equity share is 100 rupees, and again Sudha company also 2 lakh 50 worth rupees of equity shares they are holding, and then one individual equity share is 100 rupees. Now 5 lakh rupees divided by 100, we will getting in 5,000, and then 2 lakh 50,000 divided by 100, we are getting the 2,500 for number of equity shares. We got net assets value, and we got number of equity shares, that is 6,70,000 and then 5,000. So that is an 134 for the book value of the Madhu company, and then 144 for the book value of the Sudha company. That means Madhu company is acquiring company, and then 144 is in Sudha company. Okay, again next apply to the formula. So we got book value of per share of acquired company, that is 144, and then book value per share of acquired company, that is an 134. 144 divided by 134, we will getting an 1.07 of swap ratio or share exchange ratio. This is actually a ratio we got with the help of the net assets method. So what is the use of this ratio as of now? So this will utilize for the purpose of, we need to ascertain how much of shares we are going to give. Okay, so our share exchange ratio is 1.07. That means, so we are going to issue, they already, Sudha company have the 2,500 shares. So they have the 2,500 number of shares, and our swap ratio is 1.07. That means 1.07 into 2,500 share, it will become a 2,675 share. It's nothing but, so they are going to extra of 175 shares for the Sudha company, because of they are going to acquire that company. Okay, I'll repeat this again. So as of now, Madhu company is going to acquiring the Sudha company. Okay, Sudha company na Madhu company acquire ಮಾಡ್ಕೊಳ್ಳೋದಕ್ಕೆ ಹೋಗ್ತಾ ಇದೆ. So on that time, Sudha company have the 2,500 shares. Okay, 2,500 shares hold by the Sudha company. So while acquiring that company, Madhu company is going to offering the 2,675 shares. That means extra 175 shares they are going to offer for the Sudha company, because of the swap ratio of Sudha company, and so the swap ratio of Sudha company under the net assets method, that is in 1.07, and then they are holding the 2,500 shares. So number of shares is 2,500 shares, and the ratio is 1.07. 2,500 into 1.07, it will become again 2,675. It's clear. So and again, let's come to the second problem. Okay, next, second problem is about the earning per share method. So we already discussed this problem in previous video. Okay, so actual formula for the calculating the swap ratio under the earning per share method, that is earning per share of acquired company divided by earning per share of acquiring company. How can we calculate the earning per share? Earning per share, first we need to ascertain the earning per share. Earning per share formula is earning per share is equal to profit for equity shareholders. That means earning available to equity shareholders are nothing but a net profit after deducting all the depreciation and then the tax and all, we will get in some sort of amount. So that amount divided by number of equity shares. So we will get an earning per share. Okay. So first we need to calculate, first we need to ascertain profit for equity shareholders or net profit or earning available for equity shareholders. So in this problem they already given, that is an available for equity share after tax and preference dividend. Madhu is 1,80,000 and Sudha is 70,000. They already directly given. You don't want to calculate, deduct tax, depreciation and all. Okay. Annual profit for equity shareholders after tax is in 1,80,000. Yes, 1,80,000 and then Sudha for the 70,000. 1,80,000 and 1,80,000 and then 70,000. So here we got profit after profit after tax we got, and again next is a number of equity shares. So again we need to ascertain the number of equity shares. In the previous problem we already know that how much of shares they are actually holding. That is in 5,000 for the Madhu company and 2,500 for the Sudha company. So that will comes under here. So one individual share is 100 rupees and they holding the 5 lakh rupees of equity shares. 5 lakh divided by 100, 50,000, 2 lakh 50,000 divided by 100, 2,500. Okay. So now we got profit after tax or an profit for equity shareholders 1,80,000 and 70,000 as we got, and the second was number of equity shareholders we already ascertained, that's in 5,000 and again 2,500. So after dividing 1,80,000 divided by 5,000 and then 70,000 divided by 2,500, we got 36 and 28 of earning per share of acquired company and acquiring company. So earning per share of acquired company is in Sudha, that's in 28 as we took, and again next earning per share of acquiring company, that's in Madhu, that's in 36. Okay, we got 28 divided by 36, we are getting the 0.778 of swap ratio under the method of earning per share. Okay, so what does it mean? So 0.778 swap ratio means, so currently Sudha company holding the 2,500 shares and Madhu company going to offer 0.778 swap ratio under the earning per share. So that become 1,945 shares. That means it is going to reduce. So according to the net assets value, so they are increasing the shares, but according to the earning per share of the Sudha company, it will decrease to 1,945. Okay, next, the third method is in swap ratio under the market value method. Okay, market value method, they are given the formula, that is in market price of acquired company divided by market price of acquiring company. So this market price they already given in the problem, that is a market price is in Madhu company is 210, so market price of Sudha company is 270 rupees. So directly apply to the formula, so 270 divided by 210, that is an 1.29. So this market price will indicate how much of that buyers and seller activities in the market, as well as the company's reputation and company's valuation also sometimes. So if that company is doing good and then they are having good valuation according to books, means the company's shareholders will going to invest more money. So with the help of that more money, so the company's price will, the market price or an price of this individual share, it will increase. So with the help of that price, if you are going to calculate the swap ratio, it will become an 1.29. So that means 1.29 is a swap ratio, and then 2,500 is the number of shares of Sudha company. So 2,500 into 1.29. So here we getting 3,225 shares for the Sudha company shareholders. That means Madhu company is going to offer 3,225 shares for the Sudha company shareholders while acquiring that company. Now just consider three methods. Okay, first one. Okay, first one, there is a net assets method. So with the help of the net assets method, company followed the net assets method and going to acquiring the Sudha company means they have to give 2675 shares because of under this net assets method the ratio is 1.07. And again next, if they are considering the earning per share of that company, it will becoming a 1945 because of it is reduced to 0.778 swap ratio. And again last, if they are considering the market price of that individual share means it will becoming a 3225 because of the company is having the good value in the market and having the good price in the market. Clear? So this is actually a formula or this is actually a method for the calculating the swap ratio. These are all the three methods of calculation of the swap ratio. So I hope it's clear. If you have any doubts, kindly ask me, and then thank you.